On July 21st, 2010, the most sweeping financial reform since the Great Depression was signed into law. I thought it would be helpful to provide an overview of this reform and what it means for the banks, the government, and, of course, you, the consumer. Let's start by talking about systemic threats. What caused the financial reform? What was the major driver here? Well, it was because of the financial meltdown. That's what brought it to everyone's attention. And so the first thing is, how do you address bank failures? To do this, they're going to create a council of regulators led by the Secretary of Treasury and with some help from the Federal Reserve that has the authority to review large financial institutions that might be a risk to the financial system. These banks may be liquidated by the government if they're deemed a risk, and each of the banks needs to come up with a funeral plan, a systematic process explaining how they will sell off their assets and repay their debts so that the taxpayers' risk will be minimized. However, although this whole process will be paid for by the banking industry, taxpayers are not fully protected. We could still have a bailout in the future. The bill does not say that bailouts will cease to happen, and it doesn't solve the too big to fail problem fully. You know, they're trying to use regulators to identify these problems, but regulators are human, and they might miss something that is dangerous. They certainly have before. So the next big thing is tighter regulation on banks. There's going to be stricter oversight on mortgage lending. You can't just assume that mortgages will be repaid if they are considered risky, and mortgage lenders must review the borrower's income and their credit histories. Otherwise, they will be penalized. Also, banks have increased capital requirements. They need to have an emergency fund, and the size of this will be determined by regulators in the future. Some things that are unchanged are the FDIC, the Federal Deposit Insurance Corporation, Fannie Mae, and Freddie Mac. And as you probably remember, Fannie Mae and Freddie Mac cost the taxpayers a lot of money, and they're not mentioned in the bill at all. So that might be something that they will discuss in the future. They're also limiting some of the bank's activities. There's going to be a ban on proprietary trading, which are bets that are made for the bank's own profit as opposed to for clients. But it's unclear how strict they're going to enforce this. It's probably going to be pretty loose. And there are also going to be some limitations on investments in private equity and hedge funds, some of these alternative investments, no more than 3% of total capital. However, banks are still allowed to invest in these asset classes on behalf of clients. So it's important to note that banks can still make money off of these investments in some capacity. There's also going to be regulation on derivatives. The derivatives will be traded on exchanges, most of them anyhow, and this will create increased transparency. Banks can still trade most derivatives, including gold, interest rates, foreign currencies, and stock options, but they will have some limitations on energy derivatives and certain precious metals. So because these are considered extremely high risk. As you probably know, derivatives, especially credit default swaps, were a major factor in the financial meltdown of 2008. And there is another loophole, by the way. Custom derivatives. Banks can create their own derivatives that for clients that cannot be traded on exchanges, and they can use these derivatives to speculate without having to be as transparent. So it'll be very interesting to see how the government approaches this custom derivatives problem and how the banks try to take advantage of it. The rating agencies are also affected by this legislation. They have substantially reduced power. There are three major rating agencies: Moody's, S&P, and Fitch. And now the SEC and other government institutions can construct their own rating systems, which consumers may be more likely to trust. There's also greater accountability. For the first time ever, rating agencies may actually be sued for ignoring risks. If they don't do their due diligence, consumers and shareholders can actually sue the rating agencies. And so the rating agencies have a strong incentive to do a more thorough job and provide more detail about how they actually rate these securities. However, the conflict of interest problem has not been addressed. This is something I've discussed in another video. The banks are the ones paying the rating agencies for rating their investments. And this obviously creates a conflict of interest because the rating agencies have an incentive to give higher ratings in return for higher fees. So this is something that they've identified as a serious problem, but they haven't addressed how they're going to regulate it yet. Other financial players are also affected by the financial legislation, including hedge funds, which now must register as investment advisors with the SEC and provide periodic reports on trades. This is certainly a step towards transparency, but it's much lower standard than what banks are currently held to. Brokers, individuals who sell securities to other people, individuals and institutions, are also potentially going to be held to a higher standard. The old standard is something called suitability, which is if you have a security to sell, you just have to make sure that it's appropriate for the client. The new standard would be that you have to act in the client's best interest, which is a higher level of fiduciary responsibility. Now, they're still trying to figure out exactly how to regulate and legislate this particular issue, but they've again addressed it as a major problem. There's going to be a consumer watchdog, and the consumer watchdog regulates banks and consumer companies, credit card companies. It'll identify and ban products it deems unsafe. Whole process is pretty up for grabs right now. It's pretty unsafe is a very vague word. However, it's important to note there are lots of exemptions that don't fall under the watch of this consumer watchdog, including auto dealers, real estate brokers, accountants, and insurers. It's a pretty large group of people that are not going to have to report to this consumer watchdog agency. So this is something that the legislation has mentioned, but still very unclear, and not sure how much impact it's going to have. So my final thoughts on this. I think the legislation will increase transparency, which is a step in the right direction for sure. But there are still a number of problems. Incentive problems are still in the banks. Everybody's trying to get short-term incentives, which can lead to long-term catastrophes. And banks can certainly still be too big to fail. They can, if one bank fails, it could create major problems in the economy that were unintended. The last note is that this is just the beginning. Regulators still need to work out a lot of policy issues and establish a lot of processes for enforcement, and there's going to be a major battle between lobbyists and governments and consumers to fight it out. And I think that a lot is yet to be seen. But I hope this video has helped you understand the basics behind the financial legislation, what it means in general, and hopefully get a sense of how it might affect you. Thank you very much for watching, and as always, for similar videos, you can check out my website, www.canjo.com.